Welcome to The Explainer. Grab your notepads because today we are firmly putting on our world-class value investor hats to deliver a rigorous Buffett-style investment memo on a profoundly misunderstood asset. We're hunting for a massive margin of safety in a company that's undergoing a total metamorphosis, one that the broader market just hasn't fully digested quite yet. Look at this massive market disconnect hiding right in plain sight. We have a company quietly transforming into an absolute industrial real estate powerhouse, yet it's still trading at a stark discount. Wall Street is currently pricing this asset like it's some sleepy, legacy, diversified REIT, and they are completely missing the structural reality of the engine underneath the hood. And honestly, the numbers just speak for themselves. In their first quarter of 2026, Broadstone Net Lease's net income absolutely skyrocketed by 165% year over year. Diluted earnings per share hit 24 cents, which completely crushed analyst expectations. This breakout quarter was driven by a highly accretive industrial development pipeline, proving for sure that their newly stabilized assets are finally firing on all cylinders. To solve this mystery, here is our roadmap for today's 5-step valuation framework. We'll cover companies analyzed, moat and competitive position, management and capital allocation, holistic financial statement analysis, and finally, valuation. Let's jump into Section 1, Companies Analyzed. We are strictly focusing our comparative framework today on Broadstone Net Lease, trading under the ticker BNL. This is a real estate investment trust operating 773 properties that cover nearly 42 million square feet across North America. Now, as value investors, we tune out the noise. We are extracting every single piece of evidence strictly from primary sources. That means their latest earnings transcripts, the 2025 annual report, and their direct investor presentations. We are building this thesis from the ground up with absolutely no outside fluff. Moving to Section 2, Moat and Competitive Position. This is our Buffett-style deep dive into the business. So what is the actual engine here? Think of BNL as a highly specialized bank for corporate America. They target mid to large cap operators who desperately need capital efficiency. By executing a sale-leaseback, the corporation unlocks trapped cash to reinvest in their actual business, while BNL secures a rock-solid long-term yield without the usual property management headaches. Now, we all know inflation is basically kryptonite for your average real estate landlord, but BNL's triple net model has incredible pricing power built right into it. Under this structure, the tenant is the one responsible for property taxes, insurance, and maintenance. Add in contractual yearly annual rent escalators, and BNL's revenue stream suddenly becomes totally insulated, highly predictable, and frankly, it acts a lot more like a bond. To widen that moat, they're doing something drastic. They are executing a massive strategic pivot, running as fast as they can away from volatile office spaces and driving super hard into logistics hubs, heavy manufacturing, and distribution centers. They are explicitly targeting a portfolio allocation of at least 75% industrial to ride these massive structural tailwinds like e-commerce and the reshoring of American manufacturing. Here's the genius part. Buying existing industrial properties is a total dogfight right now. It's insanely competitive. So BNL basically said, fine, we'll just build them ourselves through their build-to-suit program by sourcing 85% of their deals off-market through direct relationships and funding those developments with roughly a 5% cost of unsecured debt to secure 7 to 9% yields. Well, that spread is literally a cash flow printing press. All right, Section 3, Management and Capital Allocation. Because let's face it, a great business engine is useless without highly disciplined operators at the wheel. Let's see how owner-oriented they really are. Based on our strict framework, management earns a stellar 9 out of 10 alignment score. Why? Well, the defining move was their 2025 internal management shift. They permanently cut $22 million in annual external management fees. That cash now drops straight to the bottom line to boost owner earnings. Plus, maintaining over 90% fixed-rate debt perfectly insulates them from any immediate borrowing cost volatility. Let's crack open the books. Section 4. Holistic financial statement analysis, where we unpack the cash flow over the last 3 years. Now, you might look at that 2025 net earnings drop to $95 million and feel a little hesitant, but actually those were necessary property impairment provisions as they transitioned the portfolio. Just focus on their top line. Lease revenues marched steadily upward to $454 million. And as we saw earlier, their absolute blowout Q1 proved that the newly stabilized industrial pipeline is now completely offsetting any of those legacy transition costs. Seriously, if you walk away from this explainer with just one number in your head, make it 119%. That was their Q1 weighted lease recapture rate. What does that actually mean? It means when a lease expired, they didn't just keep the tenant. They raised rents by 19% above the old rate. Why? Because these specialized automation-ready manufacturing plants are simply too critical and way too expensive for tenants to just abandon. It is the ultimate proof of pricing power and incredibly high switching costs. Okay, the moment of truth. Section 5, valuation. Let's translate all this evidence into 3 mathematical scenarios for intrinsic value. We ran the discounted cash flow models strictly based on management guidance and peer multiples and mapped out 3 distinct paths. The base case assigns a standard 15x multiple to their steady industrial execution, implying an intrinsic value of $28.50 a share. The bear case warns that U.S. industrial oversupply and high interest rates could compress that multiple, dropping us to $17.60. But the bull case, that takes us all the way to $38.70. But how do we hit that massive $38 bull case? 2 words: Project Tribor. Broadstone has $106 million tied up in this 60-acre redevelopment site. If they successfully rezone this massive plot for a hyperscale data center, the market is going to re-rate them to a tech infrastructure multiple. If they fail, that $106 million becomes stranded capital, yielding 0. So this is for sure their absolute biggest idiosyncratic risk. Here's the real beauty of this particular value play, though, and where your margin of safety really kicks in. While Wall Street slowly wakes up to this industrial transformation, you get paid to wait. Investors are collecting a highly secure 5.9% dividend yield, and that's backed by a Q1 report of absolutely 0 bad debt and 0 lost rent. So this deep dive explainer proves the fundamental moat is widening. The triple net structure works, the build-to-suit pipeline is highly accretive, and the management team is perfectly aligned with us as owners. The ultimate question, however, isn't really about the company's quality anymore. It's simply this: do you possess the strict value investors' discipline required to hold on to this until the market finally recognizes the metamorphosis? Think about that.